Hey, best ever listeners. This is Ash Patel. Welcome to another episode of the Best Ever CRE podcast. Today we've got Jeff Rosenberg, who is a returning guest. And the last time he was here, he started talking about how he was buying ski resorts and the villages around him. Amanda was on that call as well. And she told us basically to get a room because I wanted to deep dive. I had just gone to one of the resorts that he owns, unbeknownst to me. So I invited him back for a deep dive into these ski resorts without Amanda. So please enjoy this episode. Jeff Rosenberg, welcome back to the Best Ever podcast. How have you been?
I've been great. Thanks, Ash. And you?
Hey, wonderful. Thank you again. Because last time we spoke, my co-host Amanda was getting a little bit annoyed because you and I wanted to deep dive into this whole ski
That's
resort,
right.
and she essentially said, "Boys, get a room." So this is our time. We just got back from, you've got property at Powder Mountain. Is that right? And
No, not
Snow,
powder. So
sorry, it's
it's copper.
Copper
Yeah.
and Snowmass.
No,
Snowshoe.
copper, Stratton, and Snowshoe. Yeah. So
Okay.
three.
Okay. So Snowshoe's in West Virginia.
Yes.
Stratton's on the east.
Stratton's in Vermont. Yep.
Yeah. And Copper is where we came back from. That's out west.
Yes.
All right.
Yep.
So we actually loved the entire village of Copper. We had a little condo there, and there's tons of shops and bars and restaurants, everything you need in one little village.
Yep.
How did you get into the ski resort business?
Okay. Well, it was strictly a vanity play. I'm going to say that right now because I have a townhome at Stratton. And, over the years, you go into the village and you use the village a lot. As you mentioned, you're in the village, they've got food and, and shopping and, all sorts of services. And the village was poorly maintained. The village was owned by private equity. They were looking for returns. They did not reinvest that much back into the village. And so it had lots of deferred maintenance. And so it came up for sale, all three of them. And I'm like, all right, this is ridiculous. This place looks terrible. It's a bad experience. We'll buy these ski areas because at the time I thought that experiential opportunities were important for customers. So being outside, having a good experience was an opportunity to invest in.
What year was this, Jeff?
Oh, that was 22 or 21. It was during COVID or right after COVID.
All right.
And I would say copy, but by far, so Stratton and Snowshoe are mostly leased by Alterra. Right. So they're like a quick serve restaurant or a single tenant asset because the majority of the rent's coming from Alterra and they lease most of the spaces. Copper's different. So Copper's powder, right? So as you said, Powder Mountain owns Copper and they don't have a majority of the spaces. A lot of the spaces are independent operators. And so, sorry,
Sorry, go
I
ahead.
was just going to say when we bought Copper, it had lots of vacancy. And so it had lots of opportunity that Stratton and Snowshoe did not. Stratton and Snowshoe had opportunity based upon CapEx and improvements and customer experience and a little bit of vacancy, but very little. Copper had a lot of vacancy and lots of opportunity.
Stratton and Snowshoe, are they essentially like triple net leases? Or are you still responsible
Essentially,
for? Okay. Okay,
yeah.
so you have this private equity deal that you're looking to acquire. Two are simple. You just
Yes.
essentially collect a check and manage the deal.
Yes.
But Copper is the challenge.
Yes, copper's complex. So copper, I think there are 11 homeowners associations, and each homeowners association has their own fees and dues and responsibilities. And then there's a homeowners association for the entire village. And so there's all sorts of different requirements for the various different homeowners associations, because the villages, these are all condos. So in effect, we bought a village of condos, right? So at Copper, each unit is an individual condo in the building that it's in, except it's not a It's not a residential condominium. It's not someplace you sleep. It's someplace you serve food at or sell clothes at.
For our audience, it's essentially like maybe having a mall where everybody pays into the association, but you have your own shop or store.
Yep. Yep.
And you don't own any of the residential. Those have their own HOAs associated with them. But I'm assuming you have to play
Well,
a
no,
lot.
that's not true. That's not true because
Well, let's
the
hear this.
11 HOAs are the residential. So they're the building HOAs. And so, we may have two commercial units in a building of 100 residential units, and we're all in the same HOA.
Oh my god. How is this a good
So
idea?
it's definitely been a challenge. So it's interesting because it was definitely a challenge to negotiate and to deal with. I think we've done a good job. Copper looks good. We've invested in the facility. We've added lots of tenants. I don't know if you went to Sauce at Copper, the restaurant there.
No, but
Um,
we went to, was it the Irish bar there?
yep.
Went there.
So
Yeah,
you
went to some
might
of the
have gotten
ski shops.
breakfast. Yep,
Yeah,
you might have gotten breakfast there. Maybe you went to the candy shop
we did.
but I don't know if you brought kids with you, but
We
typically
did.
that's a visit. Yeah. But we added a lot of tenants at Copper. We improved the experience at Copper, and we've done really well with that as an asset. So that's been a great asset for us. It's a lot of fun. We actually bought a townhome at in Copper so that our team members could, to visit the property, make sure that the property looks good and also spend time at Copper.
What did the numbers look like when you initially purchased this? Was it a screaming deal? Was it marginal? And how much of, this will be kind of fun went into this?
So it was never a streaming deal. So as I mentioned, these deals were more like a vanity play. So the returns were always modeled in high single digit, low teens. And so the IRRs, so for those people who don't know, internal rate of return or the expected amount of money you plan to make on your investment was always relatively low. So in the, 10%, 11% range for these assets. And so they were never a 22%. I mean, we have properties where we have returned a 32% IRR and a 25% IRR. We sold a couple of properties this year. We were in the high 20s. And so these properties were never, for us, modeled to be high return properties. They were modeled to be good, strong performers over a long period of time while we invested capital to improve the experience of our customers.
Did you raise capital from other investors for this deal?
Yeah. Yeah. We have a group of investors of like 1,500 investors that we raise capital from that have invested with us over the many, many, many years that we've been doing this.
People love to scream about their investments. Something like this, was it exceptionally easy to get investors in it because of the cool factor?
It was. It was. It was a fun investment. The returns weren't as high as the returns that we offer on many of our other investments, but it was a fun investment. And, we had I think we've held some events at some of the ski areas and they're fun. And it's a, it's a different opportunity. We actually tried to buy more resort retail. And so we call it resort retail, right? So it's a retail surrounded by a resort in and we tried to buy more, but we were not successful in acquiring more assets similar to this. And today you don't see anything trade like this. And one of the biggest problems we have is how do you value it? Because nothing trades. There hasn't been since we bought these. There's been no trades of resort retail generally in the marketplace that can give you a comparison of value.
When your investors say, "What's your exit plan?" How do you even answer that question?
That's a tough question to answer. I mean, so typically we model to 5 years, but we do tell our investors that many of the properties that we bought are generational and that if we have an opportunity to keep them for a longer period of time, we will. And so that's what we've done on many of our properties. So as we discussed earlier, last year we rolled up 7 of our iconic properties into a core fund. And so we took 7 properties worth about $1.1 billion and rolled them into a fund where we could continue to, as a group, own these properties long term, but give our investors the opportunity to gain liquidity once the lockup period ends, and they could ask for a redemption of their shares based upon the fund docs. But so we decided that there were properties that we want to keep over a very long period of time, but it's not fair for us to lock up investors for that long period of time because people have different needs of capital over their lifetimes. And so the roll up allows us to offer redemption rights to those folks who want to redeem their units to invest in other things. And for those folks who want to buy redeemed units to continue the investment in the fund that we have.
How do you determine the price of a unit when somebody wants a liquidity event and somebody else wants to come in?
So there is a whole mechanism for valuing the actual units, and we do that with third-party valuation services that provide us with a per unit price that we then use. And that happens at the end of the year on a yearly basis. Because in real estate, values don't change much on a throughout the year basis.
Interesting. So at the end of every year, people have the option to redeem after a certain lockout period.
That's correct. That's correct. And the redemption rights are based on, how much cash we have and, other factors. But yes, it allows our investors to potentially redeem their units to use their capital for something else.
I love that model. What are your thoughts on what we're seeing a lot of, especially in multifamily right now, where they have 10-plus year holds, or they just come right out and say, this is a generational hold. We want you to hand it down to your kids.
Well, so I would say that some of the multifamily so I'm not I have investments in multifamily. I don't really we don't buy multifamily. I invest third party. I would say that sometimes rolling properties up from an individual ownership to a fund allows you to keep those properties for a much longer period of time and hopefully fix some maybe interest rate or capital issues that you might have incurred during the purchase of these properties. But there are examples out there today where rolling those properties up does not fix core issues with multifamily. And there are today multiple issues in the multifamily. So I would say if I love what we did with our properties, rolling them up into one, unit where we could then continue to get the benefit of the ownership of these properties for a very long period of time. But these properties were well financed, they were well purchased, we bought them at the right price, we bought them at the right time, and they come with a very good basis. Rolling up does not solve, sometimes a capital issue.
So even going beyond the roll up, we see a lot of initial offerings where people will start a fund and they'll just say, we're buying this asset. We plan to hold it for 10 or more years. Would you personally invest in something like that? Like, I don't feel good about giving somebody my money for 10 years with no liquidity options whatsoever.
I think 10 years is tough. For me, the biggest problem with 10 years is an expected return is based upon a outcome that's 10 years in the future. It's hard enough to predict an outcome that's 5 years in the future. You're asking someone to believe an outcome that might happen 10 years in the future, which to give you an expected return over that period of time. I don't know what the cash on cash is, but the only thing you can rely upon, in my view, in a 10-year hold period is what you're getting on a yearly basis in a cash on cash return for your investment, because the ultimate outcome has so many variabilities that the expected IRR you know,
Throw a dart.
is yeah, is really hard to predict. I mean, 5 years is hard enough. A lot of times we've never been exactly what we predicted. We've either been higher or lower on the 5-year plan. and that's just based upon market conditions. That's the time we decide to exit on a property. But 10 years, I have I have a difficult time with 10 years.
Yeah.
I have a difficult time with 10 years.
It's all marketing and it's nonsense. I'm not a big fan
But I
either.
mean, how can you even? So you just said, would you invest? What IRR would they give you for a 10-year hold
It's
period?
all look,
It's
they're all these are always mid-teens IRR, right? It's just the
right.
going rate. And how do you know? Again, I think a lot of those 10-year deals, they're banking on time, giving them more cushion from bad decisions. You can outrun a lot of mistakes over a 10-year period in real estate.
Yeah, you can, but look what happened so in yeah, and we discussed this last time. We were very aggressive during COVID, right? We purchased a lot of assets during that period of time. And that was a benefit to us in the retail side. Well, if you were really aggressive during COVID purchasing multifamily, you're feeling lots of pain today, right? Because you bought multifamily 3.5, 3.75, 4 caps with expectations of, and you know this better than anybody, expectations of rates going up, of rental rates going up a certain percentage. So your underwriting has rental rates going up. You're borrowing agency money at what, 2%, two and a quarter at that point in time.
I think the lowest was 3.5 maybe? But, yeah, it might have gotten lower, yeah.
Yeah, and then today, right, you saw a lot of supply coming on board. You saw rental rates, stabilize or soften, and you've seen cap rates go up for multifamily. And so today there's more of a struggle. So you've got two dichotomies. You've got retail. When we bought retail, when nobody was buying retail and tenants weren't paying rents during COVID, today is, looking like a very good investment. And some of the multifamily during that period of time is not looking so good.
Yeah, and for the best ever listeners, you have to go back, if you haven't already, listen to Jeff Rosenberg's first podcast that he did with us, and he talked about putting it all on the line during
Right.
COVID and just going for it. I think you shared with your wife, like, this is gonna make or break us.
Yeah, and you know what? And thankfully, we didn't have to live in one of our rental homes. So yes, but
Yeah.
but it was. And, the ski areas were purchased in a similar period of time. And we thought that was a good investment for us to make and a fun investment for us to make. And, one of the things I love about real estate is that it's tangible and physical, and it also makes a difference in people's lives. And so, I was just at a groundbreaking of one of our developments in Texas. We were there with the mayor and the local people. And, the development that we're building is going to create 750 jobs, create $100 million worth of revenue that will be taxed for the municipality, and will create a really significant difference in the community and in individuals' lives who are going to take advantage of the services that we're providing for this in this shopping center. It's a big shopping center, but that makes a difference to me. The ability to make a difference in people's lives really is impactful. And it was fun because it was impactful for our lenders that were there and for our equity partners that were there. And the mayor was very complimentary about what it's going to do for their community.
How big is that center?
I think that's gonna be 700,000 square feet, I think,
Alright, that
when
is
we're completely
massive.
done. So it's a big center, and it's got, but we're almost fully leased. We just started moving dirt, and so it'll be done mostly by the middle of next year.
Jeff, we spent 4 weeks skiing in Colorado this last winter, and everybody we spoke with said it is the worst winter in 50 years because of lack of snowfall. I'm thinking this could have gone one of 2 ways. So, we spent a lot more time at the bars and restaurants because,
Mhm.
the slopes were okay, they weren't great. Did did that help or hurt your tenants?
It was mixed, and so we have a really strong partnership with Powder, and, Powder did say that this was one of the worst, but I will say that copper actually came out better than most of the ski areas in Colorado and in the West. And so they had actually more snow and more trails open than many other ski areas. And so we sort of lucked out. And I don't remember what the number was that we were down, but it was not nearly as significant as many of the other ski areas that surround the Copper facility. And so we did fine. Our tenants did fine. Nobody, went bankrupt. Nobody closed. Everybody survived. Everybody was able to make a living. And so we deemed that a successful season when, we basically came out of it unscathed.
How do you go about getting financing for multiple ski resorts at once?
It's very difficult because again, it's very hard to value ski areas because ski areas don't trade. The retail and ski areas don't trade. So they're all local banks. They're banks who the officers ski or have places at the facility who understand the value of what you're buying and want to participate in the financing of the facility. It's not national. It's not Bank of America. The national guys don't know what to do with the ski area, right? And so it's all
Yeah,
local,
they would laugh at you. I mean, they wouldn't even take your call. You call
right?
JP Morgan, Bank of America, they don't even know what department to send you to, right? This
Right,
guy wants to buy
right.
a ski resort. So that was gonna be my guess, was either maybe a combination of a hyper local bank, but you have 3 different resorts that you purchased at once. Does that mean you have 3 different local bankers in those
Yes,
locations?
yes.
Okay, my other guess would have been maybe the private equity company carried some of the note. Did that
No,
happen or no? Okay. They
no,
wanted
no.
out.
Yeah, they wanted out. We didn't ask. I mean, so we have lots of banking relationships. We've been doing this for a long period of time, and so we just used three local banks again that have experience in those ski areas and understand the value of what we were buying, and wanted to see the facilities improved.
So this is the same as the investors wanting the bragging rights. These local lenders, how cool is it for them saying, "Yeah, we did the loan on this"?
They actually like the loans, and they're very happy with the loans on these products. And these are longer term loans. These are not 5-year loans. These are longer term loans, and we never get any calls from them. They are very happy. Sometimes we get calls when they go to the ski area and they say, "Hey, it looks great." But other than that, it's a definitely a different experience in the ski area business. But I really wanted to buy more of a similar type asset. Again, resort retail, which is what we call it, but it's limited. And resort retail is really difficult because of all the associations that you have to deal with and all the competing various interests that people have and want to put forth.
Yeah, if we go back to the ski areas for a second, my opinion is most of these types of deals are monopolistic and predatory because they're controlled by very few companies, right? Vail Resorts,
Yes,
iconic for being
right.
incredibly monopolistic. So my guess is there's not going to be many more of these that come to market, but there's got to be a big demand for people that want to buy what you have. Have you ever tested the market?
We have not. We have not. I don't even think we've thought about it at this point in time. I think we're just happy with the investment we have. I'm happy that we're able to invest capex and improvements at the various ski areas. And we work with all the ski operators, Altera and Powder, to improve the experience of the customer. And that's really, at the end of the day, our goal. We have not, all of our shopping centers, go through a rigorous evaluation on a yearly basis to determine, how much longer we're going to keep the center, whether it's time to trade out, whether we want to refinance it, whether we want to recapitalize it, whether there's an opportunity for other improvements at the center. And, every year we look at the ski areas and, we continue to be happy owning these assets.
Jeff, a lot of your tenants, I think, are mom and pop tenants, right?
They
They're
are.
not these
Yes,
nationals that have credit backed ratings.
that's
So
correct.
you took on a significant risk by buying this property. knowing, there's maybe a young couple or young individual that put everything on the line to open their store and accomplish their dream. But there's not much in terms of stability when it comes to that. And there's not much in terms of recourse if something goes wrong. How did you
Well,
underwrite that?
well, first of all, it's only a copper that's the case, right? Because Altera is the majority of
Yep.
both Snowshoe and Stratton. And so, Altera's done very well over the years, and so their credit is strong. And so that was easy to underwrite. It is harder to underwrite at Copper, but Copper also had the most opportunity to improve the facility with with new new food and beverage options and new experiences. And we were able to do that over the last couple of years is improve customers' experience. But you're right, it's all mom and pop. It's not credit tenants. It's people who work really hard at their business, and this is all that they do, and it's what they love. And I think the difference is that when you go to these facilities, they love being at the mountain. They love the lifestyle that they have. They choose this for a very specific reason. And, it's not because they're hanging out and they want to open a store. It's because they love being in the mountains. They love skiing. They love, summer activities. And this is a passion.
And
Yeah,
they
this is
set the
not
vibe. Right.
and they
They
set the
set the
vibe, and
vibe.
this is
Yeah.
right, and this passion you don't find in other mom and pops, and, you find it regularly, but you don't find it as consistently, as the entire mountain is passionate about skiing and summer activities and outdoors and, customer service and providing the best for the resort guests that are around.
Jeff, in terms of finding other resorts, retail areas, have you looked at anything in Gatlinburg, Tennessee, or Nashville?
We've looked at anything that might have come up as available. We haven't actually gone out and knocked on doors and said, "Hey," but if you think about resort retail, usually those are, parcels that are owned by the operators themselves. And so it's very unusual to find something like Copper where you can buy all of the retailers' condos because typically in the past, those would be independently owned, right? So if you go to Gatlinburg or if we go to Breckenridge, right? If you walk down Breck's Main Street, which I consider resort retail, that's all independently owned, right? I mean, that's not owned by Vail Mountain or Breck. A lot of that is owned by the operators that are within those stores.
And
And
they don't want to
so
sell because they're printing money,
yeah. Yeah,
right?
now I
And
don't know about printing money, but they don't wanna sell.
but yeah,
It's hard to buy. It's hard to buy.
right, they're generational holds and passed down
Yes.
often.
Yeah.
Yeah,
Yeah, so those are
interesting.
really hard to buy.
What's next for you?
We talked about this a little bit before. We like development. I really love making a difference in people's lives, and I would say that the ski areas, the resorts make a difference in your experience when you're there. Uh There's not been a lot of retail development in the last 20 years, and so I think there's an opportunity to continue to do retail development in areas that make sense, that will be a positive impact to those surrounding communities' lives and livelihoods, and so we wanna continue to do that as well. I don't know, I would buy more resort retail if it was available. I think if it sort of melds into our vision of helping to improve experiences. And so we would do that as well if it was available. But I do like the development side. And it's today it's hard to buy retail real estate. We bid on assets, we get outbid all the time. We want to continue to grow our portfolio, but it's hard. There's a lot of capital today chasing retail real estate.
And retail vacancy is at close to a 20-year low.
I think I want to say in our portfolio, our vacancy is like our occupancy is 97%. I think we're at 3%. And yet, as probably your listeners know, anytime you get above 95%, you're basically leasing space that you have no value from the bank from, right? Because banks usually take a 5% vacancy factor on anything that they finance or value. And so anytime you go above 95%, you're basically signing leases without a potential value in the future from a bank if you want to
Right.
refinance. Now, I will say that banks have been more lenient and have gone to maybe a 3% vacancy factor, which is better.
Yeah,
But
I think
at 98% or 97%, what our portfolio is, is just phenomenal.
nationwide, the retail vacancy is between 4 and 5%. So
Yeah,
it's incredibly healthy. Are you looking at developing ground up or redevelopment existing centers?
ground up. So redevelopment is interesting. We've done that in the past. We just finished a target in Wilmington, North Carolina. So, which was a whole redevelopment. We bought this shopping center years and years ago and had a parcel and ended up selling the parcel to Target, and they opened up in May. And that was a very long process. I mean, development takes years. I think the Dallas development we started 2 years ago or 3 years ago, a long period of time. It takes a long period of time.
For our best ever listeners that want to find out more about how they can invest alongside of you, where should they go?
They can go to bigv.com and we are just in the process. We've never actually offered opportunities for investors to invest alongside us. We have our core group that we've had for many, many years. And in the past, we've never opened up an opportunity for folks to invest alongside us. But actually, I've decided that we need to change that because retail is dynamic and fun. And so we are creating a new website called Big B Direct, which will allow, you know, people to invest with us in projects that we feel strongly about.
Amazing. And folks, it's big V, like the letter V.
That's right.
So, yeah, please reach out to Jeff Rosenberg. Jeff, thank you again for being gracious with your time, coming back and sharing more of your story.
Absolutely, Ash. Anytime. Appreciate it.
Hey, best ever listeners, if you enjoy this podcast, please leave us a 5-star review and share it with someone you think can benefit from it.